do think that, kind of with the supply, the stuff that's in process will get delivered, and then stuff that should be started this year and probably next year will not get started. And so, if it's 18 to 24 months to build a building, 2025 and 2026 should be two pretty damn good years for rent growth.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Hello everybody, welcome back to the Path to Wealth podcast. I'm your host, Hannes Henschel, and today we have a very well-renowned man in the multifamily industry, Michael Becker. The principal at SPI Advisory, a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $2 billion in assets. Prior to SPI Advisory, Michael worked as the Vice President of Principal Business Relationship Manager at Wells Fargo for almost a decade. He also used to host the multifamily investing show with Michael Becker and the Old Capital podcast, interviewing the top players in the real estate industry. So many of you might have already heard some of his content and things he's been speaking about over the last decade. It's a delight to have you here today, Michael. Thank you so much for making the time.
I appreciate you having me on.
Yeah, of course. So, we're just about waiting for the next Fed meeting going live in about 1.5 hours from now. What are kind of your thoughts? What is SPI doing right now to protect their investors, but also to keep going and making use of this part of the market cycle?
Yeah, listen, it's been a wild ride the last few weeks here as we're kind of recording it towards the end of March here of 23, and last week was quite a bit of volatility because the week prior was a failure of the SVB, the Silicon Valley Bank, and the interest rates were going down at the beginning of the year in January, and then reversed in February, went up, and then they went down about 100 basis points last week. So it's been pretty damn choppy, to be honest with you. So it's been interesting trying to stay up with it. So as you kind of mentioned, we've done, I think, almost at this point almost 14 or 15,000 units, and we're based in Texas, so we own properties in Dallas, we own properties in Austin and San Antonio. So there are three markets that we focus on, and over the years we started out with a lot of workforce housing, and then we sold most of that, and we're just kind of more kind of A to A minus. So what I own is kind of early 2000s up to kind of brand new construction. So, and I'm in Texas, so kind of that's the lens of the world I have a view through. If I was sitting in New York like you are, or sitting in San Francisco, I might have a different view of the world, but that's kind of my perspective. And where our portfolio kind of consists of a variety of different types of debt on our assets, anywhere from long-term fixed rate debt, and we have some floating rate debt. Well, it was on some regional bank bridge loans. Don't really have debt fund money. We didn't really do that. Then we have some life insurance company money as well. So some mixture of all that is what we have. And the early part of my career, I started buying properties in 2013. We did exclusively kind of Fannie Mae, Freddie Mac, 10-year fixed rate mortgages. Those were kind of the 5% range, give or take, maybe a little bit above 5%. And you would get a whole year of interest only. And the thought process in 2013 and 2014 was that's a really good, attractive rate, and someone will come one day and assume our mortgage, and it'll be accretive to the situation, and we'd be paid for having this loan. And then we found out that you could do 12-year loans and get 3 years of interest only. So we did a bunch of those, 14, 15, 16, we did a bunch of those, kind of the same thought. If 10 is better, 12, 10 is good, 12 is better. And, what happened was the exact opposite thing, right? The interest rates fell even further. 3 years of IO turned into 5, or 6 years of IO, and 5% turned into, the threes or 4%. So we had a lot of large prepayment penalties because those loans come with either yield maintenance or defeasance prepay. So it's pretty restrictive. And so we pivoted like a lot of folks, and we've done some more floating rate debt because we paid either in reduced sales price by having to offer the deal as a loan assumption, or an actual yield maintenance. We paid tens and tens of millions of dollars in prepayment penalties over the years. So the last few years we've done a lot of floating rate debt, So whether that's with Freddie Mac, had a good 10-year product that was 10 years of term, 5 years of IO, and it'd be floating, and you buy a rate cap. So we did a whole bunch of that, and then we had a handful of loans with a regional bank that were 2-year loans that were floating, that didn't have a cap, and they have a hard maturity on them. So that's kind of, we have some of those, and so kind of answer, this is a long-winded wind up to answer your question, what are we doing? But just kind of setting the stage. Last year in 2022, I think we ended up selling 9 assets, so we bought 3. So we're basically like a 3-to-1 net seller. And as we entered into 2023, we had 2 more in escrow, which have both now closed. So we've sold 2 already in 2023. So some of these we absolutely top ticked at the beginning of the year, last year, beginning of 2022, got absolute, peak of the peak market pricing. And then some of them we got, pretty good pricing as it was kind of coming down throughout the year. And then I feel like we got paid above market on the most recent ones we sold. So I feel pretty happy with the values, but they weren't as high as they would have been if we sold them, got awarded in January of 2022. Because about this time last year, kind of ending March going into April, when the Fed started hiking last year and started, kind of cooling off the sales pricing. So, what we've been really focusing on, I'm sorry, I've been rambling here, but what we've really been focusing on lately is kind of doing some spring cleaning, right? So we've been doing that for a while. We've sold a bunch of our old assets. We got younger, so we got better quality, better located deals. That was a process of many, many years that we kind of just basically just wrapped up. And then now some of these floating rate deals, we've kind of taken a mixed bag approach. So, earlier this year, we refinanced 2 of them. And we went floating to floating. What we did was had some loans that we put on right after COVID, like in August of 2020, Freddie Mac floaters. They had like an all-in rate of 5% with the interest rate cap, but it was like a LIBOR or SOFR spread, SOFR-based loan with like a high 2% spread. It's called about 2.8% spread roughly. And we had SOFR. So then we bought an interest rate cap that was 2.2 strike. So the all-in rate could never get above 5%. And the lender makes you impound money on those on a monthly basis. And so those went up dramatically, the cost of the cap. So the escrows went up dramatically. And so a lot of our escrows went up, 20 times, so 20 to 20x, not 20%, 20x. So what would be, something that we spent $100,000 on would cost, $1.4 million. And then you had a lot less time to catch up. So your escrows were sucking all your money up. So what we did is we refinanced it. The strike the lender gave us on the rate cap was around 5%. So it's go from 2.2 to 5%. And then the spread got lowered. So we actually ended up buying a lower strike. So we replaced the all-in cap at 5% all-in. But the monthly impounds are based off the higher strike. So it's really freeing up a bunch of cash. So we've done that. And then we have a couple of deals we're about to close on here in a week that we're actually taking fixed rate debt on through some life insurance companies, but they only have 2 years of lockout. And then we have a flexible prepay after. So we're kind of taking a little bit of a mixed bag approach where some of it we went floating to floating, and some of that we kind of went floating to fixed, but we made sure we had flexibility within our prepay. So we will pay a little bit higher loan spread because of it, maybe by about 25 basis points or so, 25 basis points. But I'm not going to be stuck in the yield maintenance for 10 years like we had learned early in my career and having to pay, really, really large prepays. We have about 2 more we got to do right now. And so we're kind of taking this mixed bag approach. We just want to make sure, the fixed rate's great, but you don't want to get stuck in something forever and ever, and because I do feel that rates are about to top out. This is probably the last rate hike we see, and they'll be cutting rates before you know it. 3 to 6 months from now, they'll probably be cutting rates. So you don't want to get stuck in something that you can't get out of for 10 years.
So overall, it really sounded like you're unloading some of the older inventory, as you said, getting yourself in a place where you also have the dry powder to take advantage of what's about to unleash. If we peak out here, this is gonna be an opportunistic market, and it sounds like you're ready for it.
Yeah, so as far as opportunity, I mean, I kind of see I do think we'll see some opportunity. I think it's right now there's some opportunity today is more from like the developers, the merchant builders that built some assets that have a bridge loan that got to pay them off, right? They just have a maturity coming, and their business model is they build it, lease it up, and sell it. So those guys are getting a little bit more real with where the marketplace is. They're kind of meeting the market today because their construction costs were set, maybe 2 years ago. So they're still way in the money because the inflation has driven the replacement costs higher. So what they would cost to build today, they have a lot lower basis, and they can sell and still make a profit, even though it wouldn't be as great as it would have been 12 months ago. So those guys are still pretty much transacting. There's been very little inventory, and they're starting to see a little bit more kind of come on, but it's still pretty low from a historical standard. Is around the workforce housing. What was very popular, which we didn't really play into the last several years, was a lot of debt fund financing. So it was a fund that people raise, and then they go out and a private lender will put money out, and then they go sell the loan and securitize it. And so those loans typically had 3-year maturities. They typically had around a 4% spread over LIBOR or SOFR. And so when you started these LIBOR or SOFR were around, 5 or 10 basis points, so 0.1%. So if you had a 4% spread, you pay 4.1% when that started. Now, after what's expected to be the hike here shortly after we record this, it's going to be almost up to 5%, high fours on the SOFR. So now they're paying damn near 9% interest rate on these loans. And a lot of them have interest rate caps that kind of mute that in the short run. But when that cap expires or when the loan comes up for maturity, they're not going to be able to refinance out. So we can kind of be in a flexion point. So I think, if you bought a deal in late 21 and you put 80% leverage on it, and you bought like a 70s deal in Dallas or Texas or the Sun Belt, you probably are off for at least 20% from the peak pricing if you paid the absolute top of the market. So that means all your money, all your equity's wiped. So, but those guys haven't had to realize to buy a replacement cap. Those debt fund lenders don't make them escrow for the replacement cap like Freddie Mac does. So they haven't had to realize the pain as they go, even though they're actually incurring it. And so if they sold now, they lose all their money. So they'll sell the future, and hopefully things will change. But if it doesn't change dramatically, there's going to be a whole lot of those deals kind of coming to market is what I feel, and I think that's probably kind of consensus of a lot of people I talk with. So we'll see if the reality turns out to be that way, because if everyone's thinking one thing, maybe something different happens, and if they slash rates, maybe that'll kind of give a reprieve. But what we haven't seen is mass layoffs. We haven't seen our tenants lose their jobs and haven't been able to pay us rent. So if that happens, then that'll cause another pressure that we haven't really seen yet. So hence what we're trying to do is get our house in order. We sold a bunch of deals. We raised a bunch of liquidity, and hopefully we'll have the courage to go out and buy a bunch of the stuff when and if the pricing gets a little bit more attractive.
Yeah. What is the appetite? You said you're getting liquidity in place. What is the appetite of your investor base? What are the conversations you're currently having with your LPs? We primarily syndicate, so we have a lot of kind of regular high net worth people, probably like a lot of people on this podcast, and we did a big equity raise. Last big one we did and we started it right after Labor Day of last year. Raised $33 million and bought a new construction deal, and it was hard. I mean, that was a big check to go right, and it was challenging. If you go back in time to that moment in time, I think we had 275 basis point rate hikes, and the stock market was down about 10 to 12%. In that 30-day window, I was raising money, so sentiment was pretty tough. And so what I kind of took away from it was a couple things. There was some general fear in the marketplace because there's a lot of uncertainty. A lot of people that, the other thing that really got kind of crystallized to me was that a lot of these investors not invest with me, might invest with you or someone like us, right? That
go out and syndicate. So they're in a bunch of deals. And a lot of the feedback I got was like, hey, I would love to invest with you, but I had 5 deals that were supposed to sell that I'm in, were supposed to sell. Only one of them sold, so I'm fully invested. And till one of those sell, I don't have the liquidity to reinvest, right? So a lot of the passive investors are kind of, they allocate a portion of their invested capital towards multifamily investments or private placements. And I don't think I really fully appreciated until I went through that, how much of our money is like the velocity of these deals trading every 2 years. They put $100,000 in, and then 2 years later they get $200,000, and then they take that $200,000 and put $100,000 in 2 different deals. There's been a lot of that going on that's really kind of dried up with the lack of sales volume. So as we kind of go in this year, I'm a little uncertain exactly how deep the pond is. We have a pretty good database, and we've personally returned a lot of money to a lot of people here through a bunch of sales. So I feel pretty good about it from that perspective. But we're probably not going to step out and go too heavy on an equity raise. We probably want to maybe start around half of whatever the last one was, just to make sure we can get home and get it done, just because it's a little uncertain out there. And I think fear is kind of leading people to kind of pull back a little bit. But that's the moment in time where probably the best opportunities are probably to come. And with as much liquidity there is in the general system, I don't know how long the opportunity or how long the window is going to be here, because, especially in the multifamily, that's still a pretty favored asset class, and the people believe in the long-term viability of it. It's just going to be a moment in time, and hopefully we can take advantage of it. But yeah, to answer your question, I'm a little unsure of exactly how bullish all our investors are at this moment in time. We haven't put an offering out in a little while, and next offering, we're going to do a small offering here shortly. That we'll need to kind of just get, we have a 1031 that we need to kind of raise a little bit to kind of top up. So we'll see. That should be no problem. But when we go out and try to raise 15 or 20 million bucks, I'm a little uncertain about how it'll be received.
Yeah. In 2022, I think it was at the beginning of 2022, you were talking about the liquidity tsunami kind of. Do you think, given the overall fundamentals of multifamily, especially in Texas, you think the overall appetite is still there on an institutional level, and that this makes or keeps the space very competitive?
Yeah, so what you're seeing kind of real time play out, there's been very little inventory hit the market. So in the Sun Belt and then Texas specifically, where I focus, there's been 2 kind of larger operators sell a bunch of deals. So one is Blackstone. So maybe you may or may not, if you follow financial media, you heard about their B REIT. And so it's like a private REIT that they raised a bunch of money, and they have all these redemption requests, and they haven't been able to meet the redemption request. So they put out, I think, like 15 or 16 deals across the Sun Belt, with 4 or 5 of those being in Texas. And we're actually buying one in Austin. We got awarded one of them in Austin. But those deals got absolutely attacked. I mean, they got 20, 30 offers on each one of those deals, because there was just nothing else to really kind of focus on. And so they actually had quite a bit of interest on them. The pricing actually was still pretty attractive in my view on most of the deals, because the pricing got reset to, say, the peak pricing of a year ago. So the pricing was still pretty attractive, but there's quite a bit of interest. The other group that's came out with a bunch, they just launched a whole bunch more, is Cortland. So they're also a publicly traded REIT. So I'm assuming they're having some redemption requests. They need to generate some liquidity. So they've sold a bunch of deals, and then they just launched another whole batch of deals that they're going to sell in Texas. And I'm sure they're selling some others across the Sun Belt as well. So those are really the ones, and you haven't seen a lot of the private groups kind of come out. But with that said, to answer your question, there's still quite a bit of demand for the deals out there, but there might be a little bit of kind of a scarcity premium being paid in the immediate term. And then if you see a lot more inventory, that scarcity premium probably goes away, because there'll just be more options to look at. But the institutions right now are pretty much pencils down, and have been for several months. They are not actively bidding on it. So it's going to like family office or more private syndicator groups like myself that are having the opportunity to kind of buy these things. I think the institutions, from what I understand, just some meetings I had at NMHC and just kind of talking with the brokers who are pretty plugged in, a lot of the institutions are in the process of kind of working to market their portfolio. So they need to write down the values of their funds And until they write that down, which sounds like it's going to be kind of first quarter, second quarter, they're not going to be able to go out and buy more stuff. So when the second quarter gets over, it seems like the institutions will probably have most of that kind of done. And the back part of 2023, they'll be a little bit more active than what they are right now, because right now the institutions are kind of pencils down. So it's just really more private capital out there doing it. And then there's just not much inventory. So if we see more inventory in the workforce housing, it's going to give more options for the private capital. So the scarcity premium kind of goes away a little bit. And then the institutions come back, they'll bid up the Class A stuff, but they don't buy, 70s vintage deals or 80s vintage deals typically. So that'll kind of be more of your private capital buyers.
Yeah, I mean, there's a reason institutions stay in prime locations and they want more prime assets, because they want to be able to unload them and they want to be able to have professional management around. They don't want to deal with that stuff at the end of the day.
That's right. You get better debt options too. I mean, we have some nicer deals that we're refinancing that if they weren't built in 2018 or 2019, we wouldn't be able to get the type of loans on them, and you'd be stuck pretty much right now with just Fannie and Freddie, because all the banks and the debt funds are pretty much not loaning money right now. So we're fortunate to have the agencies and the multifamily space, so they're always going to provide some level of liquidity, which kind of puts a floor in our marketplace. And then having these nicer deals, a lot of these life insurance companies are still loaning money out there, and their loan demand's pretty down right now. So we're actually getting courted by a lot of the life cos on a couple of these refinances. So it's kind of an interesting little mix of kind of what's going out in the marketplace right now.
Yeah. When it comes to the regional banks that you mentioned, you did mention that you also got some liquidity and financing from them. I guess all of us in the last week learned that we have to vet our banks. And I mean, you originally come from the banking sector. How do you personally, or as somebody who protects investors' capital, how do you vet your bank? Like the banks that you do business with? And many of our properties hold more than $250,000 in the bank accounts. And how do you, as an operator, as somebody who has all of that money in the bank, how do you vet regional banks?
Yeah, that's something you hadn't really had to think a whole lot about, and then all of a sudden you did. And so we've been banking at like regional kind of community banks for the most part, because it's easier to deal with, waive the fees, and easier to send wires with. And so we're probably going to have to move some of that liquidity, especially if you have like an escrow account or something like that holds 7 figures. You might need to move that to Chase or Wells Fargo or one of the what do they call it, systemically important banks, the SIBs, I guess is the acronym we've been seeing in the news lately. So that's probably something that we're in the process of kind of figuring out. It just kind of came up on us real quick. So I think that's probably something we need to do. Plus, you can get kind of institutional money market funds, so they'll pay you 4% versus if you keep it in a checking account at the bank, you're in 0. So there's actually some level of yield that never really was there for the longest time, is now here today. So you need to make sure you're doing the right thing and getting yield. So obviously protecting it plus getting yield. So we're kind of in the process of getting some of that stuff implemented, which we haven't really messed with in the past. So it's been kind of it's been interesting to see kind of the banking failures. It seems to me like they're about to get up the FDIC insurance and kind of backstop all the banks is what it kind of seems. Reading through the tea leaves, we'll see what reality is, but that's what it kind of seems like, to stem off all the banks. To me, it would personally be a shame if through this process they kill all the community and regional banks and make Chase and Wells Fargo and Bank of America even larger than they already are. I think that'd be very bad for our economy, because my commercial real estate lending, I think 60 to 70% of it comes from a regional or community bank. So it's a pretty important part of lending out there, where you don't typically get a loan from Wells Fargo or Chase Bank on multifamily assets. So it's usually agencies or for multifamily. But if you own like a retail strip center or office building or industrial building, a lot of that stuff comes from regional and community banks. So they're very, very important to the overall economy. So I got to think they got to figure this out somehow to stop the run on the regional banks and keep them viable, because if they kill that, it's going to kill a lot of the lending and could probably cause a pretty major recession at the end of the day.
Yeah, I mean, definitely. And you really don't want to pull the capital into these, or push rather, into those major banks and just like make them really too big to fail. And as you said, then they're relevant for the system, and you need those small players that make sure that all of us have liquidity for our deals in those local regions. And
Yep, for sure. Yeah. So hopefully they figure it out. We'll see. They're gonna probably manufacture the crisis here, so they're gonna probably throw a bunch of money at and cut the rates and backstop a lot of deposits. So we'll see kind of how all that plays, and we'll see how kind of your inflationary, deflationary forces. If you stop a bunch of lending, it's going to be pretty deflationary. So it might kind of kill a lot of this inflation by generating this recession. So we'll see how it all plays out. So I think kind of the moral of the story back when we started this conversation is trying to make sure that you have some mitigation in place, and mitigating factors in place to kind of offset some of this risk. And I think we've been having a saying around the office here lately, is kind of survive until 2025, so I think if we get 2 years in the future, a lot of this is kind of be behind us, really, to be honest with you. So, and now I'm getting a little bit older. I'm 44 years old. When I started, I was in my mid 30s, and now I'm kind of in my mid 40s. It's, the 2 years goes by pretty damn quick. I mean, COVID was over 3 years ago when they locked us all in our houses for a year or so. And so now you put that in perspective, this is, 2 years from now is less than time when COVID lockdowns really started. So it's a moment in time, and things always change, and it never typically gets as bad as you think it's going to be. And when it's really, really good, it's not going to be as good. But, I think this is really what my third real big cycle that I've kind of been through as my professional career, and kind of had the dot-com bust when I was really young, and then had the 08, 09, and now, thought it was going to be COVID, but that really kind of turned into this. So it's probably really an extension of that. And, I think when you start seeing monkey JPEGs go for, tens of thousands, $100,000, and, cryptocurrency and all this kind of crazy stuff come out, it's probably a tip that you might want to, probably closer to the end of the cycle than the beginning, and maybe you should, fix the rate on the loan that you want to own and generate some liquidity, or sell the deal that you don't want to own through a cycle. There's some tell, back in the .com. I mean, you had, all the pets.com and all the different the internet stocks that were ridiculously overvalued, and they were there for a year or two before everything blew up. So there's some signs out there that you can pay attention to and try to get out of. We did some of it. I wish we would have done a little bit more than we did, but I'm glad we at least sold what we sold and refinanced what we did.
So what is given that you just now took the time to look back at the last couple cycles and decades of your own life, where are you taking your personal vision for your firm and for your real estate portfolio over the next 1-2 decades? What are your personal goals and aspirations?
Yeah, so we've been kind of we started out. It was my partner Sean and I, and we had one employee, so it was like 3 guys doing deals. Then all of a sudden we did almost 15,000 units. So all of a sudden we had to become a company, that can process all the K1s and investor distributions and handle all the stuff that comes with it, plus run all the assets on top of that. So we've really, over the last 10 years, systematized and got a bunch of processes and procedures and systems in place to kind of manage all that, all the stuff that comes with raising, hundreds of millions of dollars, buying billions of dollars in real estate. So we've kind of got that set up. I still work in the business quite a bit, which I enjoy, but I'm trying to get a lot of things. I still do a lot of things I don't want to do, and then but you got to do them. So I'm trying to get those things off my plate, either through technology or hiring, key team members to kind of take those tasks off of me. So we're much better than we used to be, but I still have some work to do. And, kind of go through some succession planning, and, I'm only 44, so still got hopefully long, several decades ahead of me before I'm done with this. So we have some time to do that, but I'm trying to, every year get a little bit better to be more off my plate, more into a more sustainable model. And how do you exit this one day, which isn't anytime soon, but got to kind of think about that as every year goes by. So we're just kind of working through that, and I think we got certainly one or two more kind of good cycles ahead of me before I can kind of set it and forget it. The good thing about what we do is we'll have some assets, and now we've been doing this a while. I have some stuff we've owned 7 or 8 years that were purchased with bases of 7 or 8 years ago that have that absolutely just print money because the values have gone up, and I mean, rents have damn near doubled in seven or 8 years. So the rents that were $800, $900 are now $1,500, $1,600, and our cost basis is what it was back a few years ago. And we sold obviously a lot of deals on top of that. So it's kind of cool, at some point you just kind of set these deals, and I don't need to be so transactional at this moment in my career. I like being transactional. I like doing deals, but if we just kind of stopped and just owned and operated what we have, we'd be perfectly fine for the rest of our lives. So I feel pretty fortunate that we've got ourselves in that position. But if we don't, we're always in escrow to buy or sell, or we're always refinancing something with a portfolio like we have. And the rare occasion we're out of escrow for a month or something, in the meantime, I kind of get bored, not having something to actively work on. So I think we'll try to stay transactional, but get more and more people that can do a lot of the grunt work that I don't necessarily want to do anymore, and take that off of my plate. So that's kind of I don't know if that answers your question, but I think we have a bunch of opportunity coming, and we're going to try to be active and take advantage of it, and really lean in when everyone else is kind of getting a little scared. Hopefully we can have the courage to lean in and buy some stuff, because I think there's going to be some good opportunity. I just don't think the window is going to be as wide as it was in 2009 and 10, 11. I mean, really, you had all the way up until 2020 to buy deals, because that window was so wide before it got frothy in 21 and 22. So I don't think we have anywhere near that window. It might be 12 months, might be 18 months for the best deals before pricing snaps back. That's what my crystal ball is telling me, or what I'm expecting to happen, at least.
Yeah, that's kind of what I'm hearing too, what the sentiment is. I mean, there's some people like Charlie Young who are a lot more bullish, but I think overall that's the similar sentiment that I'm gathering right now. Michael, thank you so much for taking. Oh,
yeah, and he was a little later in the game than me when he was selling his older stuff. I mean, Charlie's a good friend of mine, and I know he sold last year. He got out of most of it. He had a bunch of really tough workforce housing and some challenging locations, and he got out of, I don't know of all of it, but a good chunk of it. And he's been trading up in a kind of Class A. I sold my workforce housing probably too soon and went to Class A a little too early. I didn't realize cap rates were going to get to like 4% on the 70s vintage deals. Otherwise, we would have held a little bit longer. But I think that's what Charlie's a guy I respect, and he's doing very similar things to what we did. He was a little behind us in timing, but it's hard to argue with that guy and his success level. So he's probably right. And I mean, I do share the sentiment. I'm kind of bearish in the intermediate, near term, and kind of bullish in the intermediate to long term, especially if you're in Texas. I mean, the fundamentals of the housing market and the replacement costs are being so high. If you could buy a lot of these deals that are newer relative discount to replacement costs now, or maybe buy these workforce housing deals at a hell of a discount to recent trades later this year into next year, I think those will both be pretty good strategies.
Yeah. Replacement also is kind of, while it is at a peak in terms of what's being finished, we're also seeing a lot less getting started now, given the financing of things. So there will be, again, less that's coming to market, yeah. 24, 25, 26.
Yeah, you would think at some point that would have some downward pressure on labor when they don't have as many jobs, and some level of materials as the supply chain system gets a little more normalized to what it was, back 4 years ago, I guess. At this point, I don't know if it gets exactly back to where we were, but at the same time, they're also nearshoring and onshoring a bunch of stuff. So a lot of the stuff that's been kind of produced in Asia is now getting either produced in America or maybe Mexico or Central America, where maybe the cost advantages aren't quite as great as over in Asia, but it's a little bit more durable of a supply chain. But that might cause some upward pressure on pricing for some of that stuff. We'll kind of see how all that works, but I do think there'll probably be some level of softening and replacement costs, but it just hasn't happened yet. It just really hasn't. So I think maybe next year as the new starts stop, that'll be there. But like I said, I do think that kind of with the supply, the stuff that's in process will get delivered, and then stuff that should be started this year and probably next year will not get started. And so if it's 18 to 24 months to build a building, 2025 and 2026 should be two pretty damn good years for rent growth. I don't see any way that we don't make a big push forward and rental rate growth in 25 and 26. So if you can buy in 23 and 24 to get ahead of that, you should get paid pretty handsomely in those 2 years.
Yeah. Well, we're both looking forward to that. Michael, thank you so much for your time. One of my favorite questions at the end is always, what do you consider a life well lived?
I think making an impact on people, my own little way, right? So we've been fortunate enough to do really well for ourselves with our investments, but we've done, really well for a lot of families and investors of ours over the years. We don't typically take institutional money. We take a lot of private capital. So we've made a lot of people a lot of money over the years, and then that affords me the ability to travel, which is one of my hobbies. So I got my life set up where the technology nowadays, you can work from almost anywhere. So getting to go travel and go experience the world and take my kids around and give them culture and things I didn't get the opportunity to grow up with, or help out my parents and my in-laws when they need this or need that, or took my sister on a big family cruise last week, so that she couldn't afford on her own. So it's been kind of good to go experience.
Well, Michael, thank you so much for your time. Definitely make sure to add those to the show notes. All of you who are interested in having part of the upside, make sure to check out his website. And thank you so much for listening and tuning in today. Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.